Hello, good morning, viewer. Thank you for returning to my channel, Hocantalk again. And today I'm going to use this video to introduce a very important topics in the financial and business world, which is called the trade finance. Trade finance. And again, as usual, I really look forward to your subscription and help so that I can continue to use my 40 over years of financial experience to explain and impart all this knowledge to you all that will benefit your career and your general knowledge. Okay, do subscribe. Now, again, like usual, this video will be presented, this trade financing will be presented in both English and Chinese. So for those people who want to listen to Chinese presentation, you can look forward to another video from me. It's not a direct translation, so it's going to be equally lively to listen to both languages. Now, as usual, I'm going to use a marker and pen method so that I can go straight to the point and give you the substance rather than formality in the video. Now, again, today's topic is a very interesting topic called trade finance. In Chinese, it's called 贸易融资,贸易融资. Now, trade finance is a very common financial arrangement between between importer and the exporter. So if you look at this slide, trade financing, there are at least four parties involved. Usually there are four parties, but normally there might be more, including shipping company and all this. But purely for the finance point of view, there are four parties. One will be the importer, one will be the exporter, and one will be the buyer and seller. So when I mention these four party, they are actually representing international trade or even domestic trade. So for example, when a country is very big, like in China, in USA, in Russia, when a company is very big, it also involves trade financing because the buyer at one side of the country might not know the seller at the other side of the country. So there's no trust in between. They don't know whether is it reliable to send the goods over. What happens if the seller, what happens if the buyer don't give me the money? Likewise for international trade that cross border. So the importer worry that if I pay the exporter first, will the exporter give me the goods, or vice versa. In order to bridge all this gap, that's why there is trade finance. And trade finance is the financing arrangement facilitated by banks to ensure or to encourage trades between different parties. Now, let's look further into the trade finance structure. Generally, in addition to buyer, seller, importer, and exporter, what are the external parties involved in a trade finance? Now, we are focusing trade financing on shipping, meaning all the goods that go through the sea, go through the ocean. The same trade financing will apply also to goods travel by air, transport to another place through aeroplane. The concept is the same, but again, for simplicity of this video, I will just focus on the shipping side. So if you look at this chart, the party involved are, again, the importer and the exporter, the bank that helping the importer, the bank that helping the exporter. And in between these four parties, there is a shipping company that's supposed to bring the goods from the exporter to the importer. So that's how the trade flow globally. So when someone want to buy something, for example, USA, there's an importer in USA want to buy something from China, then the Chinese company, the Chinese exporter will engage a shipping company and ship the goods over. But trade financing exists because, number one, the exporter and importer might not know each other, so they need someone to come in to back up their credibility. So in this case, usually they get a very reputable bank to step into this transaction to give comfort to the other party that if you ship your thing over, if everything is in place, the money will be paid. So it's more like a confirmation. It gives a comfort to a global trade. So the shipping company is the one that bring over the goods from the exporter to the importer. And when the shipping company receive the goods and put it on the vessel, they will issue a document called Bill of Ladings. bill of ladings, okay, to represent that the ownership of the goods has been transferred to the shipping company, and the shipping company will transfer this product all the way to the destination country. Now, the bill of lading, all these things will be passed on through the bank, and so the exporter, after they loaded the product on the ship, after they receive all the shipping document from the shipping company, they will go to the bank, so that the bank will process all these document and then courier all these document over to the bank that helped the importer. So the bank and bank, the relationship between two banks, there is a relationship called correspondent banking, which I will cover in the next video. So the bank and bank, they do talk to each other very often, daily basis, and they know each other very well. They know the credit standing of bank. So in this case, bank can trust bank, despite the fact that exporter and importer, they do not know each other. So they are using the credit standing of a bank to substitute the credit worthiness in this global transaction. Okay, so I put down on this chart, the shipping is done by the shipping company, but all the document will flow through the bank, and the document will go to the importer bank. After everything is in place, then the importer bank will pay the money to the exporter bank. So this is how a trade financing flow is about. Now, of course, if there is trust, then the use of trade financing will be lower, because if there's a trust between the importer and the exporter, then the usage of trade financing will drop. So for example, sometime in a rare earth, in a very precious product, the exporter will say, hey, I don't need all this trade financing, you must give me advance payment. If I don't see money, I'm not going to ship the thing to you. So in this case, there is either there is a reason for the exporter to be so demanding, or there is a big trust between the importer and the exporter. So in this case, the advance payment, meaning that the importer will send the money over to the exporter, and taking the risk that the exporter do not send them the goods. So if there is trust, then both party, importer and exporter, can use advance payment, or they can use open account, meaning there's no terms. Once I send it to you, then at your best time you pay me the money. So it's like open account. There's no they trust each other, will fulfill their obligation. It could be money in on the way, goods on the way. So this is an open account arrangement. Now there's another third arrangement when there is a trust between the importer and exporter, meaning that after the exporter put the goods on the shipping company give them all the bill of lading, plus all the invoices and all these things, they will send it to the importer. The importer, after looking document, once they receive the document, they will do the payment. So it's called document against payment. Once you pay, then you receive the document is yours to keep. Now there's also document against acceptance, meaning that if you accept this document, then you pay. So all these are mainly for there is a very good relationship between exporter and importer. Maybe they have been doing business for a long time, so they trust each other. By going through this method, the cost involved will be much lower, because for trade financing, the bank will charge a fee in whatever role they play, whether they help you to issue a letter of credit, or any involvement of bank need to pay a fee to the bank, or even pay interest costs if you borrow money for them. So in this case, the bank is not involved in this transaction, maybe only for the current account or checking account. But again, all these, if there is a trust between importer and exporter, then all these trade financing can be kept to the minimum, and the cost of transaction can be kept to the minimum. But what happens when there's no trust? When there's no trust between the exporter and importer, or they have never met each other, they have never dealt with each other before, so then the trade financing will be involved. Now, when the trade financing involved, that means that the bankers represented importer and the bankers represented exporter will be involved in this trading relationship. Now, when bankers are involved, they had to come out some documents. Come out some documents to substitute the credit standing of the importer or the exporter using their bank credit standing. So in this case, there are some financial document that will be produced. One is called the letter of credit, which I will go into detail deeper. Something like trust receipt. So they are involved in trust receipt, which is something to do with financing of the importer or the exporter. and also their bank guarantee. So banks sometimes will step in as a guarantor to guarantee that the payment or the delivery of goods will be done according to the contract. And another thing is called trade credit insurance. So in this case, if the exporter and importer does not want to go through the bank, they can also go to an insurance company. Like the exporter say that I'm going to ship something to the importer. In case he doesn't pay, then the insurance company got to pay. So they will pay an insurance premium to buy an insurance policy to safeguard against default payment, meaning the importer receive the thing they don't want to pay, then the insurance company will pay. Now, because this video is about trade financing, I want to focus very much on trade financing arrangement between the bank and the importer or the exporter. So the bank roles in this case is to substitute the bank credit standing of the importer or exporter so that there is trust in the international trade and to make sure that the trade can go on smoothly to facilitate trade. So the importer exporter does not really need to trust each other as far as their banker trust each other. They are respective banker, and the banker know the importer or exporter well. So using the bank as a substitute of credit standing will help to facilitate trade even among importer and exporter that have not dealt with each other before. So the relationship between the banks and the importer or exporter will go around some financial document which I mentioned before, like letter of credit, trust receipt, and overdraft. They give an overdraft account, a current account for checking, issue check, and banker guarantee. So typically these are the arrangement in the trade financing arrangement between the bank and the importer. Now let me see whether the next slide, what is letter of credit and what is trust receipt. I will go deeper at the subsequent slide. The rest is quite straightforward. Now, typically when in trade financing, there are four flows. Okay, remember, four flows in a trade financing. Once there are bank involved and import exporter, so there are four parties plus a shipping company. But now we are talking about the flows. There are four flows in the trade financing. So remember clearly. Number one, the exporter and the importer, after they talk to each other, they agree on the terms of the shipment, the product, and the pricing. They will sign a contract. After they sign a contract, the exporter will start producing the product, and then they will ship the product over to the importer. After the exporter ship the product through the shipping company will give the exporter bill of lading, meaning that the legal possession of the product has been transferred to a shipping company, and the shipping company is responsible to bring the product from the exporter to the importer. Now, the exporter now, together with their invoices, together with all the inspection certificate, shipping insurance certificate, certificate of origin, packaging list, and whatsoever, they will go to the bank. So this is called the document flow. So the product flow is through the sea, but the document doesn't follow in the ship. The document go through courier, DHL, FedEx. They will go through the bank. The bank will send to the importer bank, and then the importer bank will check with the importer. Everything okay? Then they will effect payment. The bank will effect payment. Now, of course, ultimately, the one that pay for the payment will be the importer. The one that receives the money will be the exporter. But what happened before they can actually pay or before they can actually receive the money? They need some financing from the bank, like some help from the bank. Then the fourth flow will be the financing flow. Okay, so now I repeat again. There are four flows in the trade finance. Number one is the good flow, the flow of the product. Number two, the flow of the document. The document will flow through. Number three, the flow of payment. And number four, financing flow, if there is any, between the importer, exporter, and their bankers. Now I want to go further in details. Like just now I mentioned, maybe I swap the slide a little bit. Now just now I mentioned there are document flow in the trade finance. So now the document flow that the exporter need to provide will be the bill of lading. In Chinese, it's called 提单, meaning this will be issued by the shipping company, the commercial invoice, the packing list, the certificate of origin, and the insurance and the inspection certificate, insurance certificate and inspection certificate. And then all these documents will be given to the exporter bank. Now, talking about letter of credit. Now, what is letter of credit in trade finance? I mentioned just now that when there is a relationship, when there is a use of trade financing, the importer and the exporter, the exporter and the bank must have a facility, meaning the bank is willing to represent the exporter and issue a letter of credit. Importer, the relation between importer and the bank. So when the importer want to buy something from the exporter doesn't trust the importer. So the importer will ask their banker to issue a letter of credit, meaning using the credit standing of the bank to represent the importer credit standing. So the exporter, even though they don't know the importer, but they know who is the issuing bank of this letter of credit. So the bank of the importer will issue this letter of credit in favor of the exporter bank. In favor. Now, so I want to go deeper into what types of letter of credit. Now, letter of credit is the most commonly used financial document in trade financing. So I repeat again, just now I wasn't very clear. If an importer wanted to import something from the exporter and the exporter doesn't trust the importer or don't know the importer will ask the bank, their own banker, to issue a letter of credit to give comfort to the exporter so that the exporter is willing to take the risk to ship the goods over to the importer. So the letter of credit is a kind of bank facility that the bank is willing to help the importer. But is this free? The answer is not free. The bank is willing to do this and they will charge a fee. So sometimes, depend on the amount of the letter of credit. For example, if the shipment is 100,000 US, then they need to open a letter of credit of 100,000 US, then they will charge a fee. Sometimes 1.8%, 1.16%, or sometimes 1%. So the letter of credit is being used in this manner. The letter of credit is a kind of guarantee issued by the bank to replace the credit standing of an importer. Now, there are many types of letter of credit. Most of them will be a side LC, meaning the importer, the exporter bank, or the bank, once they see the letter of credit, they have to pay. It's called side, meaning you pay immediately. There's another LC called USEN LC, meaning that you see it can be USEN for 2 months, 3 months, I mean you pay 2 months later or 3 months later. So all the document in place, does the importer bank need to pay? The importer bank need not to pay immediately. They issue a USEN LC. So these are the issuing bank. So if the importer bank issue a side LC, meaning that when you see the LC, they will have to pay immediately. If they issue a USEN LC, then when the exporter bank receive the LC, they have to wait for a certain time before the importer bank will pay. There's something called the revolving LC. These are bank facility that give to the importer. So the relationship is between the bank and the importer, got nothing to do with exporter. Exporter will have the same kind of relationship with their own banker. So the importer and the bank is willing to give a revolving LC. What's revolving LC? Meaning that the bank will tell the importer, if within 10 million, I'm willing to support letter of credit up to 10 million. So if you issue 1 million for the shipment number 1, you still got 9 million to go. After that, you repay, you go back to 10 million. So it's called revolving. It's not per issuance, it's revolving. They give you a line, you can issue, repay, issue. That is called revolving. Now, back-to-back LC is when there's a middleman involved, and the middleman doesn't have the financial arrangement with a bank, so the importer can actually use a back-to-back LC. So they involve intermediary and agent. So again, this is not very common, but I mentioned this. There's something called transferable LC. So for example, one importer want to help the other importer, and the other importer doesn't have enough bank facility with their own bank. They can actually get another importer to help to issue a transferable LC, meaning it can be transferred to another importer. There's something called a standby LC. This is more like a guarantee, meaning that instead of issuing one LC at the same time, the bank of the importer give an open LC, meaning that up to 10 million we are willing to support letter of credit up to 10 million for this importer. So there's a standby LC, something a bank guarantee. Okay, so now to keep this video short, this will be the scope of the letter of credit, which I think I cover most of them. So if you deal with bankers, you mention all these things, they know what you're talking about. And when they talk to you about site LC, USEN LC, which are the most popular LC used, you immediately you know what they are talking about. Now, I want to go further deeper into the finance flow in trade finance. That is a relationship between the importer and their bank, or the exporter and their bank. Or it's not cross-border. So, of course, importer, in order to get a bank to do all this service for them, they had to pay the bank a fee. And also the bank has to be comfortable with the importer credit standing. So again, there will be a banker and client relationship. The bank will always evaluate how strong the importer is. If the importer is weak, the bank will charge a higher fee or higher interest rate, or they don't even want to do business with the importer. Now, there are two very commonly used instruments in this aspect, which I think I have the duty to guide all my viewers. One is called the trust receipt, which I mentioned earlier. Now, what is a trust receipt? So, for example, a trust receipt means that when the importer imports something and they get the bank to issue a site LC. Now, when the ship has arrived and the site LC need to be paid by the importer banks to the exporter bank, what happens if the importer got no money to pay the bank? Then they can activate a facility called the trust receipt, meaning that the bank will pay first on behalf of the importer, then later charge the interest to the importer, and then the importer will pay back the bank through installment or by end of period payment. So this is the kind of arrangement. It's something like a loan. If the importer doesn't have money to pay for the goods through the letter of credit, then the bank that issue a letter of credit can pay on behalf of the importer first. Now, what is called confirmation or LC? Now, confirmation or LC, for example, if an importer issue a letter of credit through the importer banks to the exporter, but the exporter still doesn't feel comfortable, he still find that he doesn't want to take the risk, so the exporter can ask the banker of the exporter to confirm this LC, meaning to add another layer of bank guarantee on this LC. So in this case, there are two banks involved already. The one that issued the LC, which is the importer bank, and when the exporter still want to get more comfort in the trade, he can ask his own banker to confirm the LC, meaning that his own banker will give another layer of guarantee onto this whole transaction, meaning that if the importer bank fail to pay, the exporter bank will pay the exporter. So this is called confirmation LC. And confirmation LC will need to be paid a fee. Again, this will be commercial decision between the exporter and the banker. So why I want to go deep into all these financial terms, so that at least when you deal with bankers in your work, or you go for another job interview, when your interviewer asks you all these things, at least you know what do they mean. Again, these are the knowledge that a lot of people will not want to teach. But again, I'm teaching all this in exchange for your subscription. Hopefully you are kind enough to subscribe. I need 1,000 subscribers. Now, I finished most of the terms used in trade finance. I also highlight all the relationship in between. Now I will give you again the macro view. Now, what is the global trade, and how much global trade is financed by trade finance? Now, globally for the year 2025, the global trade is about 32 trillion US. 32 trillion US. Now, of all these 32 trillion US, about 10 trillion is financed through trade financing. Of course, there are some is direct payment, advance payment, document against payment, document against acceptance. There are more and more advanced payment now, because exporters think that their goods are very valuable. They have so many people they want to buy, so they can be more difficult in their terms. So they can say, if you don't send me the money, I'm not going to give you any goods. So we count those out. Those that need trade financing, one out of 32 trillion is about 10 trillion. It's a very high percentage. Now, which are the top 10 banks in the global trade finance? So I've listed down the top 10 banks. So in case you need these trade finance services from the bank, you know which are the top 10 banks. Of course, we have Paris Bank like BNP Paribas, HSBC, Citigroup, JP Morgan Chase, Standard Chartered, Deutsche Bank, Credit Agricole, DBS Bank, that's our Singapore bank, and ING Group, and of course, Bank of China. So again, let me recap what I presented just now. Today video is about trade financing. Once there are involvement, once they don't have trust among the importer and exporter, then there will be involvement of bank. And trade financing is all the financial arrangement created or implemented by all these banks to help importer or exporter to facilitate all this trade using the credit standing of the bank, and also to some extent they will also help to finance all this trade in case the importer or the exporter do not have the financing to pay all these business transaction. So again, I hope you benefit from my video. I always keep my video very precise so that you know exactly what you need to know for your career and for your business decision. So again, what I'm asking for is please subscribe. I'm a retired banker, 60 years old Singaporean. I've more than about 40 years in banking, in central banking, investment banking, commercial banking, corporate banking, fund management, etc. So please do subscribe and give me the motivation to continue to give you wonderful video for your knowledge. Thank you. See you again.